Thank you everyone for joining us today. I'm James Fields, President of Klingenstein Fields Advisors. I'm glad you could join us on our webinar. I'm joined today by our guest speaker, Bess Freedman, CEO of Brown Harris Stevens, one of the largest privately held real estate companies in the country. Bess will talk about a subject that is always of interest, the real estate market, focusing on New York City and surrounding suburbs, as well as the states with more favorable tax treatment, such as Florida. We hope everyone is doing well, and we certainly are in a very different and much more positive place than we were last year at this same time. And hopefully you're enjoying a safe resumption of many of your normal activities. In fact, just moments ago, Governor Cuomo fully opened the state of New York. Before I turn it over to Bess, I'll take a few minutes to briefly recap what's going on in the economy and the financial markets, and our view for what we see for the rest of 2021. During this call, you can submit questions in one of two ways. If you're listening through your computer, there's a widget on the right side of your screen where you can submit questions. Or you can email questions to mildredpalo@klingenstein.com. It's MILDRED.PALO@KLINGENSTEIN.com. Let's take a quick look at the most recent numbers for some of the key economic indicators. On June 4th, the May jobs numbers were released. While they were below the lofty estimate of 671,000 new jobs, non-farm payrolls did increase a hefty 559,000 jobs, while the unemployment rate dropped to 5.8%, better than expected. Hospitality, which has been one of the hardest hit sectors during the pandemic, was the biggest winner as the country continues to reopen. Overall, the markets acted positively, with the S&P posting a little under a 1% gain on that day, and is currently up almost 14% for the year to date on a total return basis. GDP growth has also been healthy, with 2021 Q1 GDP growth running at 6.4% on an annual basis. Estimates for 2021 full year GDP growth are currently projected at 6.5% or even higher by a number of institutions, including S&P Global, the Federal Market Open Committee, Bank of America, among others. While I won't go through all the data, one last key indicator is consumer spending, typically a sign of consumer confidence. Consumer spending has been rising dramatically, although stimulus checks are also a driver of that. In fact, according to ISI this morning, consumer spending was up on an annualized rate on a quarter-over-quarter basis of 10% as of May.
That's great.
All this data indicates to us that the post-pandemic recovery is steadily continuing. We anticipate the strength will maintain throughout the end of the year, if not longer, with the Federal Reserve sticking to its easy money policy to encourage the recovery. The two other items to touch on are the current proposed plans by the White House, the American Jobs Plan and the American Families Plan. These two plans would allocate funds to infrastructure repairs and modernization and towards affordable education and other social programs, with the current price tag of $4 trillion. The White House has also proposed tax changes, including raising the corporate tax rate, increasing the tax rate for the top income bracket, raising the tax rate on capital gains and dividends, and limiting the step-up in basis for capital gains for estates and other estate-related taxes. The corporate tax piece will likely be superseded by the new global minimum tax rate of 15%, agreed to in principle in the last few days by the G7 countries. All of these would serve to only partially fund the spending plans, which are the largest ever for peacetime and the largest since World War II. There will likely be lengthy debate and discussion on these proposals, and it remains to be seen what will eventually pass through Congress. Finally, there's been concern that all the stimulus spending and the easy Fed policy may lead to higher inflation. And over the past 3 months, many inflation indicators have supported this thesis, while in contrast, the 10-year Treasury notes sit at 1.49% now, down from 1.7% at the beginning of the year. While we are not overly concerned at this time, we are keeping a close eye on spending, on rates, on the economy heating up, and potential inflationary pressures that may result from all of these factors. It is high inflation and the associated increase in interest rates to mitigate it that typically ends the strength in equity markets. I'd be remiss not to at least mention COVID-19, although thankfully it no longer dominates the news cycle here in the United States. The slowdown in vaccinations and the emergence of the Delta variant, which originated in India and is more virulent than other variants, may be cause for concern in the future, even though the United States is far ahead of other countries, both in the number of people vaccinated and its access to vaccines. In summary, however, as we look forward, we believe the outlook is positive for both the economy and the markets for 2021. Now let's turn to the reason we're here and a topic I know that fascinates me, and it's typically one that all New Yorkers find interesting, the real estate market. Last year was probably the most unusual modern day real estate market ever experienced, with the city effectively shutting down for close to 2 months before slowly reopening, and as we noted, finally opening fully today. As the pandemic continued, we saw at least a temporary residential exodus from the city to the suburbs to the benefit of the housing market, which is still in tight supply. With many companies following an extended work from home policy, commercial real estate vacancies also rose sharply. And according to Cushman & Wakefield, were 16.3% for the first quarter of 2021, the highest rate since 1994. Of course, we also wonder what's ahead for real estate in the city. And today we have Bess Freedman, CEO of Brown Harris Stevens, one of the largest privately held real estate companies in the United States, here to give us her expert insights. Bess, who joined Brown Harris Stevens in 2013, is the company's first chief executive officer, has extensive experience in urban and luxury real estate markets, as a frequent contributor to news media sources such as CNBC, Bloomberg, the New York Times, and the Wall Street Journal. Prior to entering the real estate industry, Bess, who also has a JD, practiced law both as an assistant state's attorney in Maryland and for legal aid. And with that, I'd like to welcome Bess and let her take us from here.
Thank you so much, James, for that. I really appreciate it. And thank you to Klingenstein Fields Advisors for having me today. It's really my honor and privilege to be here. So, James, you talked a little bit about the pandemic. And so during the pandemic here in New York City, as we saw, it was sort of a flight out of the city. People were going to the suburbs. And so New York was really hit very hard because of the pandemic. And there was 3 months just about where real estate professionals could not show real estate at all. So it was like the brakes were completely on. And mind you, before the pandemic, we were in a buyer's market and we had ample supply. So having the pandemic hit was just really created incredible stress and strain on an already sort of challenged market. So what benefited us though were the suburbs. So we have offices in Connecticut, so places like Greenwich, Darien, our New Jersey market, Palm Beach, the Hamptons. People fled to those places, and we saw people going there and buying aggressively and paying, you know, above and beyond what they were asking. And so that helped those markets incredibly. Fast forward to today, New York City is now doing really well. People have returned, as you said. You know, we're open for business. Masks, people aren't wearing masks anymore. People are vaccinated. So New York City is in a much better place today than it was during the pandemic. And now those other regions are lacking in supply. There's a demand, but there's a lack of supply. So real estate is really always about supply and demand, really. And when they intersect, you really have a healthy market. And that's what we're seeing now in New York City. In the other markets, you're seeing really a lack of supply, even though the demand is there. So let me just give you a breakdown. I don't want to do a monologue. I'm going to go through a bunch of things, but I want people to ask questions. I want to give an overview in case there's people that aren't aware of how New York City is comprised, its real estate market. So the majority of real estate of the housing stock, 70% of that, those are rentals. They're just rental buildings. They are not anything that you can buy. They're only for rent. Of the 30%, and hopefully you guys can figure this out, that is left over, of the 30% that you can purchase, 70%, 68, 70 of that is comprised of co-ops, okay? So, and if you're not familiar with what a co-op is, I'm just going to define it for you.
Which means you're lucky and you're not from New York City, right, Beth?
It's true, because have you been through the process, James, of purchasing a co-op?
I have.
Yeah,
on both sides, as a board member and as an applicant.
Yeah, it's not, there's a lot of fights that go on during that process. I mean, it's challenging for people because you have to deliver a financial portrait to the board. You are buying shares in a corporation, and you get a lease and you get shares of stock. And what's good about this is that it protects you from, you know, going into foreclosure, because they are very vigilant. They make sure that you can afford to pay the monthly costs, because if you can't pay it, the co-op gets stuck, the corporation gets stuck. So they make sure that you have the income, that you don't have too much debt, that, you would be a good shareholder. They don't want to have people there that are, gamblers, don't have a lot of income, have tons of debt. So that's good in a way. But New York City mostly is comprised of cooperatives, some that don't allow any financing. We have a lot of buildings that require that you pay all cash, some 50%, but on average it's 20-25% that you have to put down, and the rest you can finance. And then of the other, let's say 30% that you can purchase, that's comprised of condominiums, and then there's a small sliver of townhouses. And the condominiums are really all these new buildings that you see going up across the city. We have Billionaires Row, which is on 57th, which I'm looking out right now at all these big, tall buildings. And those give you a lot of freedom and flexibility because you own real property. And with those, you can typically rent them easily to who you want. With co-ops, you don't have that same freedom. So if you are thinking of investing in real estate in New York City, you really aren't going to buy a co-op. You're going to buy a condominium or maybe even a townhouse, but most likely it will be a condominium. So it just depends on what you're looking for. If you want to buy something for that you're going to make it your home, and you are interested in a co-op, there's still great value to be had there, and there is appreciation. It's just different because you would be living in it. So hopefully that helps explain a little bit of a difference between New York City. Yes.
Do you have a rule of thumb for folks about what the premium is to buying a condo versus a co-op? Is there such a premium that you can think of, generally speaking?
Yeah, that's a great question. I would say the premium is probably about 15%. Give or take, could be 20, it depends, but that's roughly what it is. And because you're allowed so much flexibility with a condominium, people tend to prefer them, and you don't have to deal with the whole co-op process. For a lot of people, it's a headache. They don't want to you have to give tax returns. You need financial references from your accountant, and you need to have personal references. It's like you have to paint a whole portrait of who you are. And the board looks through this, and you go through the interview, which you've been through, James. You have an interview, etc. So, and there's things like summer work rules in some buildings. So if you want to do work, you're prevented from. There's certain time periods that you're not allowed to do work. You can only do it in the summer, and so these are things that it's strict, but it's good in a way if you're a shareholder, because you don't have to worry about somebody not paying their maintenance. And you know that the people that are there are always going to be able to pay their bill. So it gives you a sense of security, which is why we were sort of insulated, when there was a financial crash and other markets, were crashing. In real estate, New York City was sort of prevented from any of that. There was no real foreclosures. So that's a big plus. Let me go back. Let me look at a little. Oh, so you mentioned commercial real estate and space. And that it has been a bit more challenged, in the last couple of years, and the pandemic really accelerated that. You're seeing a lot of businesses go out, and you're seeing a lot of empty storefronts. And the question is, a lot of people ask, what do we think is going to happen with commercial space? We're still unsure. As you said, did you say 16% or 17% occupancy right now? I think it's going to take a little bit of time. I think it will get back on. I think it will get repaired, but it will take. We have to wait and see how things go for the next year. And so that's definitely been a very challenged market, is commercial.
Do you have concerns, Bess? Many firms, likely ourselves included, will go back on a hybrid model once we do reopen. And I know a number of other firms are considering that as well, which would just mean we don't have the same density on a typical day. But if you multiply that times thousands of small businesses, you think about all the service industries, restaurants, and others, is there a concern about a longer-term effect on the New York City economy?
Yeah, I think that could definitely have an impact. I mean, we're seeing, people are saying that they're going to just not they don't have to come into the office. So if they're working from home, I mean, that does create an issue. If people are not in the office, then people are going to downsize, then people are going to, so all of that could have an impact. It will take time for us to see what the impact actually is. But many businesses, I've talked to a lot of different people, and they're requiring their employees to come into the office. I'm sure you saw that Tiffany's announced that they want everybody to show up. We're making everybody show up in the office, because I do think there's something magical and special about being in the office with each other, a synergy, a building of culture. And I don't think you can do that from home. I think it worked during the pandemic. Doing these sorts of things are like this is okay, but it doesn't have the same feeling as when you're with each other. So it's going to take time to see how that actually pans out. I think we will get a little bit of a hybrid model in some maybe industries, maybe more in tech that can work, but real estate is really a relationship business, and so I think it's a little bit different. I don't think that we would go to that. Speaking of which, what I think is super important right now in New York City more than anything is we do have right now the mayor's race. And in order for us to keep New York City strong, we want to get obviously a good leader in place. We also have 30 some odd city council seats that are up. This is all June 22nd. And we have a city controller's race as well. And so the city council, what people don't realize is that determines the budget for New York City. And so we want to make sure that we have, I think, a moderate agenda. For some reason, and this is apolitical, I'm just saying it seems like there has been a very progressive voice in New York City that has sort of demonized the wealthy and demonized the real estate industry and demonized things that I think hurt our business and hurt everybody. It's sort of antithetical to what we're trying to do, because when you create jobs, it helps everybody. As you probably remember, the Amazon deal that fell apart. There was something in Brooklyn and Sunset Park as well that would have created something like 20,000 jobs. I think we want to try to get to a place where we can be pro-community and pro-business, and we want a leader that will support that. And so I would just encourage people to get involved, and hopefully everybody's going to vote. There's early voting now, and so I would encourage people to do that. So that's just my one little apolitical speech about just voting, right? I just think it's important.
Well, I'll bring it back to because it's very helpful. I think people should always be engaged in their local community. Is one of the things that happened last few years, but was accelerated during the pandemic, was people moving to other locations, and particularly ones that are more tax efficient, let's say, or tax friendly than New York State and New York City. And of course, we always think about Florida, and there was a great meme about Governor Cuomo's photo as the #1 real estate agent for the state of Florida. No offense to the Brown Harris Stephen team. And so what do you think about the flight to Florida, the flight to Tennessee, Texas, Carolinas, in addition to the suburbs of New York, and how sustainable is that? And is that a temporary phenomenon or more than that?
I mean, it's more than that, and it is a real danger to us. I mean, we saw businesses move. I think Goldman Sachs is in the process of, I think Carl Icahn, other leaders have set up Apollo, I think, is another company that's looking for an office in Florida. I mean, taxes are a real threat. I mean, we do, of course, people who make more money should pay more taxes. This is sort of common sense. But we shouldn't punish people because they have a lot of wealth. We don't want to serve as a deterrent for people to come and live here. There was a pied-à-terre tax that was looming in Albany. They were legislating to try to push that through, which would have really hurt the city. We already have the cap on the SALT deduction up to $10,000. And that, I think, inspired a lot of people to move. We have to realize that New York has paid its fair share, and we want people to come here, live here, raise families here. But if taxes are egregious, wealthy people are going to move other places. I mean, they'll visit New York City, but they're not going to want to live here or invest here. So we have to be very careful about that sort of narrative, because it could hurt the city. And we don't want to go back to a New York City of the 70s where it's not safe and people don't want to be here. You need people who have money to want to live in New York City, to invest here, to be a consumer here. And so there's got to be, I do believe there's a healthy balance of having, taxes should be based in economics, not politics. And for whatever reason, it's been this sort of like trying to sell a narrative, trying to get likes on Twitter, and that's very damaging. So I'm hoping that we can come back to a more moderate, business-centric place that helps everyone. As you see crime in New York City, this is every day. It's a new story. People are getting shot. It's dangerous. I don't think it's as dangerous as what you read. I think that sells papers. There's been, I think, 1,100 new police officers were assigned to be involved with the subways and show up and that sort of thing. But that would hurt the city greatly if we don't have a safe city, and it's all connected. You want people to want to invest here and be here. And so we have to keep our eyes on who's leading the charge. So very important question, Dan. Yes, taxes are very important. We don't want everybody to move to Florida. We have offices there, but we want people to stay in New York City. It's, I believe it's the greatest city in the world, and we want to keep it thriving in businesses, here. We want people to stay here. Super important. So why don't we, I know I have a whole bunch of questions. I don't know how you want to, or people have asked questions. How do you suggest? I'll
Sure.
leave it to you, James.
And we'll let Ellen come in here and guide us in a moment because she has some questions from the audience. But that was really an insightful overview, and I'm sure we'll have a lot of questions. This is something that, as for most people, their primary residence is the largest investment they ever make as a percentage of their net worth. So thank you for that color on New York City and other markets. So now, just to remind everyone how to ask questions, you can either press the button on the right side of your screen if you're listening through your computer, or you can send your questions to Mildred Palo at Klingenstein.com, which is MILDRED.PALO at KLINGENSTEIN. And whether they're about the markets for me or about real estate for Bess, fire away. And Ellen, I'll hand the mic over to you to guide us through that.
Sure, thanks. That was so fascinating. I've learned a lot. And we have a lot of great questions. And I'll start with one that actually came in several days ago. So clearly this was a topic that was of great interest to lots of people. A little bit off the track of what you've been talking about, but any insight you might have would be great. So interest in real estate that's dependent on college and university student populations, and particularly the questioner was interested in Boston, but I imagine that could be also relevant to sort of the NYU area and places like that. And any insights on that?
Well, it's funny because I just rented an apartment for my daughter in Boston, and I think anytime you want to go to a place that relies on students, it's going to give you a lot of stability because those students are going to keep coming back and have to be there and constantly need to find a place to live. So that's a different, that's a different model. It's a great, it's a little bit sort of vanilla box because you're not doing it for the one specific apartment that you're going to cherish and value. You're kind of doing it more in mass. So I think maybe buying a building, maybe a 4-unit or an 8-unit building, something like that in a place where there's a lot of colleges is a good investment as long as you're interested in doing it for the long term, because you have to buy the property and hold it for a while before you're going to realize any sort of real gain. But I think that can be very successful in the long term. In fact, I know a few people in Boston who are landlords and have done very well, but they've owned these buildings for 10 and 20 and sometimes 30 years. So the question for you in this sort of setting, if you're thinking about investing in real estate, ask yourself, what is my purpose? Do I want to do this for a long time? Am I thinking that I'm just going to wait 10 years? I want to wait a long time and let it appreciate and take, or do I need to get money out quickly? I'm looking for a couple of years? Because if you're thinking of something quicker than that, that's not going to be the best place to invest. As James said, real estate it's an emotional commodity because it is typically the biggest investment of your life if you're buying it for your family. But even if you're investing as an investor and you want to have a tenant in place, or you want to, just invest and hope it appreciates, you want to talk to an advisor and talk to someone who can advise you on the market that you're in. Real estate is very local. So think about where you're interested in investing. And the other thing is, if you're thinking about a college community, I would get myself a little bit fluent with that location. I mean, I wouldn't want to just invest in a place that I'm not familiar with, that I don't understand well. I don't feel comfortable investing in things that I don't understand. So you want to make sure, if it's Boston, you want to make sure you know the area, you understand it, you understand the community, and you feel good about it. That's something that would, be a good investment. But you don't want to just throw money, let's say, in a community that you're not familiar with. That would be my sage advice.
That's a great answer.
Just Ellen, I'm just going to jump in here for a second because I know it's something we discussed prior. we're in the internet age, right? We're in everything online. That was accelerated by the pandemic. Do you see any real volume of folks buying real estate sight unseen online? And if so, what type of buyers are those? Or are they just using it for education?
I think you only see that on $1 Million Listing, which is a complete farce. I'm sorry to break everybody's, thought about how it works, but it's just not, that's really not a reality. I mean, do people buy sight unseen? Of course, when there's a new building going up, people might buy the plan, you might buy a floor plan and purchase as an investment, but it's much more the exception than the rule. Typically, when people are buying a property, they need to see it, even if it's an investment. They want to see the building, they want to see the lobby, they want to understand the amenities, the views, how it feels. There's a chemistry involved. I mean, people are not going to, even if people are very wealthy, they want to see where they're putting their money. People are not stupid. They're not going to just spend money on something they don't see and touch and feel. It's much more than that. So it's not really a reality that people buy sight unseen. Does it happen? Of course. But consider that the exception. The rule is much more. People fly in. We had people a few weeks ago flying from California to look at a property they saw online that they liked, and they came in and they actually saw it. They put an offer in. They're buying it. But they flew in just to see this property. It happens all the time because it's a huge commitment. It's usually the biggest investment you make. So it's like, getting married. You want to make sure that you are partnering up with the right person, the right property. You're not going to just, take a chance, roll the dice, so to speak.
Great, thanks. Here's a question we've gotten from a couple people, not surprisingly, and I'm going to toss this out to both of you because I think you're both going to have great perspectives. Really sort of the difference between active versus passive and direct versus indirect investing or purchasing real estate, the nuances and what purpose each one serves.
Well, the investing piece, I'm going to let James talk about that, but because that's what you do, James, you're the brilliant one on this. But what I would say is active real estate investing is really just, for example, I own a studio apartment on 54th Street where I have a tenant in place, and that requires active. I have to give her a new lease. I have to sometimes paint the apartment, and new fridge sometimes, or, collect the rent. And, so I'm constantly, I have to pay attention. There is passive, there's real estate investment trust, which is more passive, and a company manages that for you and manages the rents and all that, and then you get a dividend. That's sort of passive investing. And so it just really depends on, you have to figure out what is your appetite and what would best suit you. If you're interested in having a tenant or tenants and you want to manage that and it's something you'd be interested in, then you want to be more of an active investor. But if you're really busy and you want somebody else to handle that, then you would do something like invest in a REIT. But James, I'd love to hear what some of your thoughts on that.
Thanks. In addition to REITs, which is a publicly traded, in most cases, all private REITs, investment vehicle, which is very passive for the investor, there are a number of private equity offerings, which are similar in the sense that you are not managing the properties. You're not building them. You're not maintaining them. You're not hiring the staff. You're not doing the leasing. You're not doing the lease turnovers and all those other things. But when we think about real estate as an asset class at the higher level, what are the benefits of real estate as an asset class? For an investor, there are a few. One is, as you mentioned, Bess, there's this income stream, right? Assuming that you have enough percent of the units leased, you have an income stream, which has some depreciation involved, so it's somewhat tax efficient. So when you think about a fixed income stream, that's sort of interesting about real estate as an investment asset class. The second piece is, once the buildings have been owned for a period of time, you have two ways to realize appreciation. One is you can recapitalize the building. Buildings are very nice because they tend to, if they're well run, be able to support a lot of debt. And so you can then take that debt and pay it out to the investors if you're the management company or you're the owner of the private equity real estate fund, or you can sell the buildings and then return the capital, of course, back to your investors. So when we think about real estate as an investment class, but that's not how we think about real estate for personal use. And in fact, when we speak to clients about their primary residence, and they say, well, it's a good time to buy. Really, if you love the house, or apartment or condo or townhouse, and you're going to live in it for a meaningful period of time, you really shouldn't be overly concerned about, are you going to make money on it? Are you going to not? It's your primary residence. You're living there. It's your home. It's part of your life. It's another member of the family, and in some cases, longer lasting than your marriage, just to make that clear. But what's important about it is that it's not about how much money you can make on your primary residence. That's for your second home or an investment property. So that would be the distinction I would make.
That's very helpful, James.
Great, thanks. Another question that's come from a couple of different people around the state and local tax limitations that are currently in place but proposed to potentially take away. And initially, did that impact the market, and what do you think would happen should they be raised or eliminated?
What did you ask about? You asked about
the STAR deduction.
The SALT.
Oh, the SALT.
SALT.
Yes, the SALT deduction. Well, there's discussion. At least, we had a Zoom meeting, Revenue Board of Governors. Chuck Schumer spoke, and we've been talking about this. They've been trying to get rid of this cap on the SALT deduction, which is capped at $10,000. And so that has served as a big deterrent for people who want to live in New York City. And so we're hoping that that's going to be repealed. There's a lot of talk about it in Albany to do away with it, which would be great, because then people would feel like they have more flexibility and they could benefit them with their taxes. But we're not sure if that's going to really go away or not. There was a lot of talk about that early on when we had the new administration. But it seems to have died off a bit, to be honest, and I don't know if we will ever change it. I'm not too hopeful at this point. So I think there's so many other battles going on that people aren't focusing on it. So that's really where I think we're up to with that.
Great, thanks. Another question that came in, you talked about co-ops and the somewhat onerous process of becoming a co-op or owning a share. Questioner says, don't condos have boards also that run the building after the builder's exits? And how much control do they have, and does that impact who can purchase?
Yeah, it's a great question. Yes, of course, the condos also have boards. You're right. They have the right of first refusal. So it's a little bit different. With a co-op, they can review your package and turn you down. They don't have to give you a reason at all. And you can think it's about anything at all. You could think it's because they just didn't like you, whatever it is. And they can and there's nothing you can do about it. I mean, people have tried to sue, but it goes nowhere. With a condo, they really can't do that. The only thing they can do is buy the apartment. That's really the only thing that they can do if they don't want to sell it to you. That's their only choice. And there is a board and there are rules. They have house rules and you have to adhere to those. And typically with condos in New York City, for example, if you want to rent out your apartment, they require to be at least a 1-year lease. You can't just rent, I don't know of any building that allows you to rent for a short term. Buildings require at least 1 year because they don't want people, they don't like riffraff. For the people that live there, they want, stability, and they don't want people coming in, moving in and moving out. So there's those requirements, and then there's move-in fees, and there's a package. You're right. There's also a condo package, and some of the condo packages are looking more like co-op packages, like they require tax returns and all the information. But it's just that you have more flexibility because you own the property, and there's very little. They really can't turn you down unless they want to buy the apartment. So that's the difference between them.
Great. Another question in terms of valuing real estate as an investment property, what do you recommend in terms of determining a fair valuation?
I think the best way to determine the value of a property is to get some comparables. You can get what's called, and you can ask any real estate professional for this, it's called a comparative market analysis. And basically what it will do is it will pull properties that are similar in a certain area. Ideally, the best ones are the ones in your building, same line that just sold. And you can look at those and say, oh, this just sold a month ago. And you can look at the price and you can kind of get an idea. It's not an exact science because that apartment may have been like totally renovated and yours may be you need a gut renovation. So you have to weigh those factors in, but I would look at what has sold in the last 6 months, what's in contract, and ask a professional to give you actual data. Any company can pull data and show you what has closed so you can get an idea as to what the real value of your property is. And that's what you want. I mean, just because you think it's worth a lot means nothing. You need actual substance to demonstrate the value. It has to be based on something. Many times when we go to talk to sellers who want to sell, they say, oh, I want $20 million for something. You say, why do you want that? Well, because I read that everything's worth this and that. And I said, but it has to be based on something. It has to be based on comparables that make sense. You can't just want it. It has to, otherwise the market will respond to you by not responding. You will get no offers and no interest. So yeah, comparative market analysis. Anyone will send you one. They're pretty easy to do.
Great, thanks. Question that just came in on the commercial side in terms of, yeah, obviously, as we talked about, impacted pretty severely from the pandemic. Even prior to the pandemic, there's always a lot of turnover in New York and empty storefronts. Are there still tax breaks, or are there any tax breaks if landlords are forced to leave their storefronts empty? Their current laws that are going to expire.
I don't know about that. I do believe, from my understanding, that they do have certain tax breaks by leaving them empty. I mean, I thought, but I guess it's not a good idea. People have been against it, is that people should be required to, I feel like they should get a penalty or a fine for leaving their storefront empty, because they should come to where the market is. If the market it used to be 20,000 a month, and now 15 would get it rented, but they won't do it because they get some tax benefit or from it. I think they should be required to rent it out, because it hurts the city to have, just from a perception, an aesthetic. When you walk up and down Madison Avenue and you count 30 storefronts empty, it's not good for tourism. It's not good for the city. And landlords should have to be required to rent those spaces out. I mean, and they should have to work with the market. I believe, I'm not fluent with taxes and commercial, but I do think there's some incentive for them to leave it empty. I've been told that. I can't guarantee you that that's true, but that's my belief. I'm not sure, James, if you might know more about that than me.
I don't on the specific tax laws. I do know that sometimes landlords are stuck between their lender and the market. And if their building is supposed to show a certain amount of rent roll, but they're not penalized for it being empty, but they are penalized if they lease it below the estimates they gave the lender a priori, that can somewhat be problematic. But my understanding is the same as yours, although it's just intuitive that, maybe just being in New York a long time, is that there is a perverse reward for keeping your storefront empty versus even putting art in the window or something else.
Exactly. And that's, to me, it doesn't make sense that you get that benefit, but people do, hold out. And it's a challenge. Look, during the pandemic, the rental market was, I believe, much harder hit than the residential sale market. And like the little landlords were really hit because those tenants couldn't pay. And then those little landlords who don't have deep pockets couldn't pay their mortgages and couldn't pay, so it impacted a lot of people. And the rental market is still in recovery mode. It's much better than it was. But that, you have that domino effect, which is always a challenge.
Great, thank you. Another great question. You talked about co-ops, condos, and townhouses. Does one structure versus another, you either tend to hold its value better during economic downturns? And did one get particularly hit by the pandemic versus another?
I think co-ops, just because of their structure, they hold their value better because they're protected. They're protected because of how they're structured, being a corporation, and that helps. And condos, because we have a lot of this new development and there's a lot of supply. During the pandemic, that was completely halted. Cranes couldn't move, nothing could happen. So I think they were impacted in a bigger way because they couldn't finish up jobs, they couldn't do anything, and so that definitely hurt the condo market more. But as an investment, it's really depends on you personally what you're looking to achieve. As James said, if you are purchasing it for you to live in, I mean, I own my apartment that I live in with my children, and I consider it an investment as well. I mean, I think but I plan to hold it for a long time. I'm raising my family there, so it's dual purpose. I'm enjoying the actual space and all those things, and raising children there. And I know that as time goes on, there is going to be some level of appreciation. And so it just really depends on what you're trying to achieve. If you're looking to just buy something and have a tenant in place, you obviously you're going to do better with a condo, but you need to hold it. You can't just flip it. There used to be a time way back when you could buy things and flip them and make money, but right now you're not able to. You're not doing that in this market. It's not really. That's not happening in New York City.
Great, thank you. This is from someone who I guess wants to invest in real estate and is wondering what you would recommend to become more knowledgeable. Should they get a real estate license? Is there a course they should take? How do they start their empire, I guess?
Oh, well, you can start your empire right away. There's nothing stopping you. Really, I mean, it's real estate is such a great field to get into. And you can get your license if you would like to. It's not very hard. There's tons of schools. You can look it up online. New York State, I think Real Estate Institute is one. You can do it online. But I would work with a professional if you don't want to do it yourself. I would, befriend an agent and talk to them and ask a million questions. Agents love to share information and they want to talk to you about what's going on. They'll send you information. I would also sign up for something called the Olshan Report, OLSHAN, Olshan Report. You can just Google it and then ask to subscribe. And every Monday morning you will get it. And if you're interested in New York City in particular, it's fascinating. It shows you how many contracts were signed over $4 million in New York City. And then it breaks it down for you what they were, where they were, which company. And you can really see how the market in New York City is doing. So I would sign up for that. REBNY is a great source of information in New York if you're interested. The Real Deal, even though it's a little bit of a sort of, it has a little bit of gossip in it, as we know. I do love The Real Deal. You can get a lot of good information from that. But I would study it, look into it. You can get books on real estate. There's so many good ones. Barbara Corcoran's book on real estate is really good. And I would just learn as much as you can. If you like it, you're going to do well at it. It's like anything. When we like something, we thrive. When we don't like things is when we're challenged. So if you're interested, go get your license, meet some agents, talk to people, and study it. Just be familiar with it, wherever you're looking to buy real estate.
Great, that was a great answer. I think we have time for a couple more questions. So, one is going to take us, both are going to take us outside of the New York market. One is you talked a little bit about the suburban areas and the demand is so great now. How do you see that playing out over the next 12 to 24 months? Will supply and demand equalize a little more, or do you think it's still going to be a really tight market?
Look, if I had to guess, nobody has crystal balls on this sort of figuring it out, but it looks like it's going to be tight for, I think, at least if I had to guess, the next year, particularly in Palm Beach. I was there maybe a month ago, and when I was there, we have an office on Worth Avenue, and we have 9 windows of all these beautiful properties. But now a lot of them are showing our properties from other regions because there's no supply. People want to buy there, but there's no limit to what people can buy. And the same with the Hamptons. There's a limit, and also people can't pay crazy. Numbers, people were asking very aggressive numbers. So I think it's going to take a little bit of time for supply and demand to reconcile in those regions, in Connecticut and in Palm Beach and in the Hamptons. It's good that the demand is still there, but I think it's starting to dissipate a little bit. And then hopefully supply will start to creep up a little bit, and it'll start to be more fluid, because right now it's not that level of fluidness. It was great during the pandemic. I think Palm Beach was up something like 300%. And that was fantastic. But now, New York City is moving and fluid and really good, and Palm Beach is slowing down a little bit.
Great. Which coincidentally was the next question I was going to ask, which was about the East Coast market of Florida, the sort of Palm Beach to Miami corridor. Is it all equally sort of tight in demand, prices up, or are there areas that you think are overvalued versus others?
Well, Palm Beach, I think, is definitely been the most popular, even versus Miami. There's been some people have been just wanting to be there, and it's done, incredibly well. Miami, not as much, even though it's been busy. There's still a decent amount of supply in Miami because, as you probably know, there are lots of new developments there. Palm Beach doesn't have that sort of flexibility. I mean, there are some buildings in West Palm, but Miami has a lot of buildings and a lot of supply. So it's been much more. I think there you can get more in Miami than you can for Palm Beach. And another place where people like Fort Lauderdale. There's been some good movement there, and there's good opportunities in Fort Lauderdale. And so, I mean, I would consider, if you're thinking about investing in Florida and you like Florida, I think you can still get some good deals in Miami. And I think Fort Lauderdale is also a place where a lot of people are, and it's convenient because you can get to different places easily. You can get to Boca, you can get to Miami, you can get to Palm Beach. So I would consider those places if I was thinking about Florida.
Great. All right, last question just came in, and I apologize to anyone whose question we did not get to. Someone will get to you personally for sure. But the last question is interesting, so I'm going to ask it because I want to know the answer, which is, is it true going forward co-ops will have to give a reason for disqualifying a potential buyer?
Oh boy, I wish that was true. No, there's no, I mean, listen, there's been a lot of attempts to try to do that, but there's no rule or law or anything that I know of that is going to require co-ops to have to explain their reasoning. And I don't see that changing anytime soon. I mean, co-ops are good and bad in a way. It may be bad if you're interested in buying one and you don't want to go through it, but it's good in the sense that it protects you from any sort of issues, for any sort of financial ruin, in the sense that the other shareholders are going to be qualified, and they just do their due diligence. And most co-ops, the majority of them are not ridiculous, requiring no financing. They're typically more flexible than that. If you have decent income and you have not a lot of debt, you can get through a co-op. It's just, if you have a lot of issues going on, they're not going to want you in the building. And so I think that makes sense, and it's helpful. It keeps them healthy and strong. So New York City is different in that way. I think we're one of the only few places in the country that is comprised mostly of cooperatives. So.
Thank you, Bess. Well, thanks everyone for joining us today. I hope you found it interesting. I know I did, and hopefully you did as well. Bess, we really appreciate your time this afternoon and your insights into the market nationally, or at least up and down the East Coast. So thanks everyone for attending, and for anyone's interested, this is being recorded and we can send it to you thereafter. Take care.
Thank you, everyone. Have a good afternoon.
Thank you.
Bye, guys. Thank you so much for having me.